Hi, I'm John West, one of the partners here at Research Affiliates, and today I'm joined by one of my fellow partners at the firm, our senior advisor, as well as a professor at Duke University, Cam Harvey. Cam, welcome.
Thank you.
With the rise of technology and robo-advisors, and perhaps you mentioned the ability to buy 25 cents worth of Berkshire Hathaway, so much of the financial advisor community has been built around technologies that are maybe becoming obsolete. Would the actual role of the financial advisor become obsolete as we make these technological advancements?
So I think no. Actually, I think the opposite. The advisor becomes more important. And it's kind of consistent with a few ideas here. So the world is becoming much more complex. It's much more easy to misrepresent, as we talked about earlier. So the advisor needs to step up. They're more important. It's their full-time job, right? So they're devoted to actually looking at these investments and making sure that there's the highest possible chance of repeatable performance in their advice. So this delegation, that is not going to end. But you might say, well, why do I need the advisor? I just need some robo tool. And what I would say to that is, I think that the advisors will be using the robo tools. So these are just tools that help us kind of optimize our portfolio. Yeah. The key thing is the inputs. So an optimizer, we've had optimization since Markowitz's 1952 Journal of Finance paper, which he won a Nobel Prize for. This just makes it a little easier for investors to actually use. And I think it's much more reasonable to expect that the advisor will be using this tool and making recommendation. But let me emphasize that you just can't hit the button of the robo tool and you're done. It's the quality of the inputs that are really important. So what are the expected returns for these assets? So what are the volatilities? What are the correlations? What are the drawdown possibilities? So if you've got a tool, it's not that useful if the quality of the inputs is really low. So number one, the misinformation, the due diligence. Number two, you need somebody to provide the quality inputs in terms of expected returns, volatilities, correlations into the robo tool. That's important. And then number three is also very important, and it's consistent with what I was talking about in terms of blockchain technology, that we will have many new types of assets that are not tradable today that would become available to investors. It's new territory. I'll give you an example that many large pension plans have the luxury of being able to invest in large infrastructure projects. Yeah. And they provide very attractive expected returns. But these are very large investments, and there's little or no way that the retail investor can access those large investments. With the tokenization of those investments, they will become available. And we've already seen this situation, which to me was dysfunctional, where you get these great startups that are at some point going to IPO. There's a market for the private equity that's not available to the retail investor. And it's very frustrating because the people that are well off are able to access these great investments. With the tokenization, there's more democracy in finance. That it's not just the giant pension plan or the high net worth individual. The retail investor has access, but they need help. They need help navigating this complexity of all of these new assets, and I think that there's a very important role for financial advisors in this.
So in other words, technology is really going to create a lot more asset classes that individual investors never had the opportunity to invest in, and they're really going to need guidance anytime you introduce new things that aren't well understood by the retail investor.
Yeah, no, I totally agree with that. The role of the advisor becomes more important, and it's naive to think that they go away because of some robo-advising tool. That's just not the case.
So advisors are going to have an increasing role in producing better client outcomes. So they actually could be a net winner in all this technological innovation.
Well, they will be a winner.
Will be a winner. What are going to be some of the other winners and losers as this shakes out?
That's a very long conversation, but let me talk about kind of the obvious losers. So the lowest hanging fruit, of course, is the banking system. And the banking system really hasn't changed that much in the last 150 years. And it's actually very challenging if you think about what happens, especially with small and medium-sized businesses. The small businesses generate a huge amount of employment growth in our economy, and they are constrained. They go into the bank for a loan, and often they're either shown the door because the loan size is so small, or take a credit card. So I think in terms of the losers, the banks will be the biggest losers, and I think they know it. And they're going to have to pivot. It will be a different business model for them. But in terms of the winners, I do think that small businesses will be in a very good position. They'll be unconstrained. I believe that there'll be many more people that are connected to markets because, look, there are 1.7 billion people that are unbanked in the world, 1.7. So what this technology allows you to do is to have a bank, and what I mean by bank is a vault. And the vault is your mobile phone or your laptop or something like that. The 1.7 billion will have mobile phones in the next couple of years, and they will be able to transact on the internet. And what I mean by transact is not just to pay for stuff, but to actually be paid for stuff.
So let's shift gears a little bit to talking about cryptocurrencies in a very specific environment. How would you expect cryptocurrencies to do in a recessionary type of environment?
So I've been asked this question before, and many people, again, are trying to talk their trade. So they've got a long position in cryptocurrency, and they say, oh, well, given that a cryptocurrency like Bitcoin, and again, we need to be careful here because there's many different categories of cryptocurrency. So if I've got a stable coin that's linked to the US dollar, well, it's just linked to the US dollar, right? So, but things like Bitcoin are linked to nothing, right? There's no discounted cash flow. There's no expected profit. We don't know what the risk is. And we've got this extreme dispersion in beliefs as to what it's worth. Many people believe it's worth zero. Some people believe it's worth $1 million a coin. And given that uncertainty, there's a lot of volatility. So the argument about the hedging goes the following way. So given that a stock we can value, we've got the expected profits that we can discount back to the present with a discount rate that reflects the riskiness of the stock. So we know in bad times, those expected profits go down, which is negative for the price. And we also know that the risk goes up, which is also negative for the price. So we can actually see that these risky assets, they should perform poorly in kind of economic downturns and do well in economic upturns. Very straightforward. With a cryptocurrency like Bitcoin or Ethereum, there's no valuation like that. So we have no idea what the value is. There's no expected profitability. There's some risk, but we don't even know how to measure that. The annualized volatility is 100%. Okay, so it's extreme. So the idea is, well, they must be a hedge asset because the value isn't linked to the economy. So we're not linked to the economic performance of the US like stocks are linked. So I have been negative on that explanation, and I'm negative for multiple reasons. Number one reason, we don't have a history. So this is a relatively new technology, quality data only available since 2012. So it's not even a recession in the data set. No recession, how can you claim it's a risk asset? And then number two, that this market is dominated by speculators rather than users of the tokens for transactions and things like that. And I think that the recent behavior of the equity market validates this idea that cryptos are not a risk asset. When the market recently tumbled, so did cryptos. And it seems that we have learned in this market downturn with respect to cryptos like Bitcoin that they are risk assets just like stocks. So if you think that you've got a good hedge asset, number one, it's hard to imagine a good hedge asset having 100% annualized volatility. That's a really unreliable hedge asset. But then you see that it moves with the equity market almost 1 for 1, or even worse. That's definitely not a hedge asset. So I think that cryptocurrencies are very useful for certain things, but if you think that they will provide a hedge in your portfolio, I don't agree with that.
Well, let's turn our attention to another asset that, like crypto, doesn't have a yield. And some of its proponents, like crypto, say it's a great hedge for something like inflation, which again is not something we've talked a lot about. But you've done a lot of work in gold, and as a matter of fact, you presented another one of our client conferences on your gold paper. Talk a little bit about the longer-term implications of what would drive gold prices higher and its suitability as an asset.
So basically, the bottom line of my research is that historically, gold has been a hedge, especially with respect to inflation. However, the hedge is only viable in the long term. And when I'm talking long term here, I'm not talking 10 years. I'm not talking 50 years. And I'm not even talking 100 years. That the viability of the hedge depends on centuries of data. So why is it good over the very long term, but not necessarily over a shorter horizon? And that has to do with the volatility. So gold is a volatile asset. It's as volatile as the S&P 500. Okay, so anytime you've got a volatile asset like that, then you run the risk that it will not perform as a hedge when you actually need it. So for example, people have talked about having gold in their portfolio for unexpected inflation shocks. And I do have a slide on that I'd like to show, and it's right here. So we've got the gold price change against unexpected inflation. And ideally, you'd like that to be a 45-degree line. So if there's a shock in inflation, well, the price of gold goes up to kind of hedge for that. And you can see that there's essentially no relation there except for 1 year, 1980. There's nothing, zero. So again, this is just some more modern empirical analysis that shows that gold is an unreliable hedge.
Well, super. This review of new technologies and perhaps the oldest technology we have, which is exchanging goods and services for gold, has been fascinating. Thanks, Cam.
Thank you.